Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, July 15th, 4:53 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market, we're in a correction, but good close to the week for the indexes. We'll get into this in a little bit. Check over here at the trend gauge. I commented earlier in the week that despite the fact that all three of the time frames that we track were bearish, meaning short term, the five major indexes were below their 21-day exponential moving average. Medium term, the indexes were below their 50-day moving average, and long term, the index is below their 200-day moving average. But leaders were holding up. Leaders, I'm really talking about the 21 over 21 list, which is a broad meaning it's at least 10 different sectors, broad list. And how are these stocks, liquid stocks, behaving versus their 21-day exponential moving average, which is our short-term indicator of strength. And although the indexes were not having a good week, in fact, this week we downgraded short-term from bullish all the way down to negative on the 12th, which was Tuesday. We saw the leading stocks holding up pretty well, the 21-21 holding up pretty well. That stayed neutral. So today, come into Friday, we've been having a weak reaction to the market. In a lot of cases, it was to the CPI report earlier in the week and the PPI report, but we gapped up this morning. And even when we were selling off, we just couldn't go any lower than 3750-ish, no matter how hard we were knocking on that. You know, the more support is tested, the weaker it gets, and sometimes it looks like you're going to break through it. And we certainly things looked bleak a couple times this week, but bulls ended up buying. There's a lot of hammer candles, which means you're weak early in the day, but you close near the top of the range. Those are littered all throughout the last 2 weeks on the indexes. And today we had some decent retail numbers before the open that caused a little bit of a pop in the indexes. We had some more good news come out at 10 a.m. We'll talk about this when we get into the tail of the tape. But the important thing was that these were held. The gap up was held, not sold off. So that's a little bit of a change in character for the market. So we closed the week very nicely. Overall down for the week. I'm pretty sure we're going to check that momentarily. But you can see from what just happened over here, very green day, and the big caps and IWO, which is the growth portion of small caps, reclaim their 21-day exponential moving average. If you're closing the week strong, that's a good sign. Above the 21, a very good sign. You know, we were back above that last week early, gave it up intra-week, reclaiming it by the end of the week. These are good signs. And when bad news comes out and the market doesn't react negatively to it, that means that there's a dearth of sellers, and the market just, as I said, couldn't really push any lower than 3750. So check out the green on the day, the G6. This is we've had some questions about this. This is our 6 ETF composite, growth indexes composite. We'll go through the charts of them during this video, but this is something that we put together in early 2021 as a way to keep a better gauge of what's going on with the broad growth sector. This is a period where we underperformed, and really what it was is a lot of extended growth stocks coming off, and we held some of them longer than we should have, gave up more gains than we wanted to. So this was part of our lessons learned, and we track this meticulously now. The G6 up 1.9%, S&P 500 up 1.92, NASDAQ 100 up 1.8, Dow up 2.15, mid-caps up 1.9, Russell 2000 up 2.2, Global Diversified 60/40 stock bond up 1.1. GROTECTION re-entered the market with the reclaim of the 21-day exponential moving average today, up 0.1% on the day. We came in with 90% cash, just 10% in VTIP, which is a short-term inflation-protected bond index, basically a glorified money market that pays a better yield than a money market, but dipped back in with SSO today to get some exposure to the market, and we'll take a look at that trade also. So let's dive into it a little bit more. You can see over here, just to wrap up the trend gauge, neutral on leaders. Still need that second close above the 21 in these big cap indexes to get off of a bearish downtrend and at least either get to neutral or to bullish if the mid caps and small caps can cooperate. Medium term and long term still under their respective moving averages. So we're going to get into the charts first. We're going to get into the team here at Revere. Reach out to us. What we do is trend following, meaning we participate in market uptrends, pull back a little bit, pull the reins back, let off the gas a little bit if the market starts to transition to a consolidation from bullish, and then if we go from consolidation all the way to flat out bearish, which is what we've been most of this year, then we just get the heck out of the way. Monitor the markets, monitor sectors for strength, and wait for the clouds to clear, so to speak, before we get back into the market. And we've got a nice lead on the S&P 500. We're down about 8% year to date versus between 19 and 20% for the S&P 500. And we'll be, the best part is when stocks start behaving better, we get to capitalize, or we get to compound from a higher asset base, because if you started with $1 million, you're only down 8%, you're at 920,000. If you lost 20%, you're at 800,000. So starting from 920, you can compound a lot quicker, get a lot higher, faster, and that's what we plan to do when the market rights itself. And if you're interested in this approach, reach out to us. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So let's get into the tail of the tape, point out what's important here, and put that side by side with our index chart. So tail of the tape, as we said, in a correction. See if we can get that second close above the 21 to get off of our bear case, which we went back to earlier this week when the rally failed and we broke back below the 21-day exponential moving average. But as I said, 37.50 held. We got back above the 21 EMA today, first close back above. So we're working on getting back to our bull case and then putting money to work in the market. So some news, gap up on retail sales beat, talked about that. Fed hawk Bullard came out shortly after the open, said he thinks we need to target 3.75 short-term rates by year-end, by the end of 2022. That took the market down briefly, very briefly, but we recovered nicely. And then at 10 o'clock, we had a big pop up on the Michigan consumer sentiment numbers that came out. Expected to be 49.9. They were 51.1. This is the first improvement in quite a while. Market really liked it. We had a pop up. Let's take a look at an intraday chart of the S&P 500 here. You can see what I'm talking about. So here's the gap up, and then we looked like we were fading right away. And it's like, yeah, just another thing. False gap up that we can sell into, but bam. Here is the 10 o'clock news. Big move up to the high of the day. We digested that a little bit. Tried to make another high of the day, which we did, pull back. So now you see a series of higher highs and higher lows intraday. We got up near this 39.60 area, and that 39.60 acted as resistance all the way until the last 5 minutes of the day. We just traded in this very tight range between 38.60 to the upside, about 38.45-ish. To 38.50 to the downside, tight range the whole day, and then we popped at the end to get above 38.60, close at 38.63. Let's zoom this out a little bit. Let's go to a 30-minute chart. Actually, let's go to a 60-minute chart. You can see very clearly. So here was the big gap down on CPI. the prior time that we reported CPI, and we were concerned that the history was going to repeat itself with this, with a bad reaction to this CPI number that we got last week, because this was the breakdown from a tight range the day before CPI, before the market open. Bad CPI number closed at the low of the range. We digested it over the weekend. This last time, this was June 10th to June 13th, and we gapped down and just that set the recent lows. Then we've had a couple of attempts at a recovery in here, and you can see how critical this 3,900 area that we're coming up into is going to be. So that set the low of CPI down day on June 10th, and we gapped below it. Tried to get back above it here, but couldn't really stay above it at the end of June, back down below it, and now you can see this 3720 to 3740, 3750 area that has really been a bunch acting as support every time that we tried to get down. So things were looking not so good here. On Thursday, that was PPI. This was CPI on Wednesday. Here was late Tuesday. We had a gap down from this tight range that we've been trading in for 2 days, reminiscent of this gap down from a tight range that we had been in for about 5 days. So then a gap down at the open on poor CPI numbers, but we rallied, closed at the high of the day. Overnight, though, another gap down on Thursday. But again, looked like we were going to break down. We broke below this 3740 level, but it was brief. We got right back above it, closed near the high of the day on Thursday. Then the gap up on Friday, closing at the high of the day. So where does that put us? Right at this 3860-ish area, and the next level up will be 3900 for resistance, and then 3900 to this 3945 area. If we clear this, there's a big chasm, a big vacuum here, all the way up to this gap down move, this gap to be filled, which is at this 4017 level. And no resistance in there. So if we get into this area, we can move up very quickly. Let's go to a daily chart on it. And here's the area that I'm talking about. We worked off of a low back in late May here. This is the consolidation. This is the gap down pre-CPI. This is the CPI day gap down. This is the Monday after CPI gap down. But again, that was back in June. That put in the lows at that point. And here's how we reacted to CPI this week. Moves down, but close at the high of the day. And look at all these situations to where recently we have bad days. Here's one bad day where we gapped up and closed at the low. This was the last failed rally. That was on the 28th. Okay, move down, get down into this 3730, 3740, 3750 area. Close in the upper range. Next day, test it again, close at the high of the day. Next day, test it again, close at the high of the day. Back above the 21-day moving average for 2 days, but then we failed on the 11th. Down below it, close mid-range on the 13th and the 14th. Again, testing this low. If this low breaks, we talked about this in our podcast, this low, this 3720, so say 3700 to 3720, if this gives way, there's not much support down below that, just this little island here down to 3637, which I would suspect we would move down quickly there just because of the lack of support. But good way to close the week. As I said, closed yesterday at the high of the day. Again, threatened the bottom of this range, but closed at the high of the day. And then today, again, a close at the high of the day. I know it's summer. I know volume's light. But when buyers come in toward the end of the day, that's a good thing. And you got to start somewhere. I know that the news isn't good, but the market looks down the road, and maybe the market will be the best forecaster of when we're going to come out of a recession. It always does. It looks forward. It seeks these things out. That's why we follow price and volume and not our opinions. So what's the next move? Up above here, this downtrending 50-day moving average, which is right now at 39.36-ish. That'll provide some resistance. That'll come right up with this 39.45 area. Should we get above the first level, which would be 3,900. So then 3,900, 3,945, and then we get above there, we've got this unfilled gap up to 4017. So that's what we'll be looking for next week. Keep a close eye on those levels, and if the markets hold up well, leading stocks will hold up well also. And if we go to the upside, leading stocks will lead the way. That's why they're called leaders. That's why we keep the 21 over 21 list, so that we always have a good feeling of what's leading the market. And then we just look for good entry points in there. But first, when we're above the 21 in the indexes, we'd like to take a sizable low risk entry. And we did that today. We got up to, let's go back to the tail of the tape to get caught up here. So what we were watching coming in, the couple of support levels, S1 held. So this was this 3,800 area. We closed yesterday at 3,780. We gapped above this area. We opened at 3,839 after the 9 o'clock. Or I think it was 8:30, retail sales numbers came out. So we started moving up. We were flat, then we started moving up, and then we gapped up 1.3%. So that support level held, and we got above at the end of the day. Actually intraday we got above this resistance level. Now, when you come into resistance, the first thing you got to worry about is you're going to hit it and then immediately reject off of it. So that's what we were looking at. But I already showed this tight chart, this intraday chart here, and all we did is go tight. And every time we got up into it, like here, first we would come back, but we didn't get rejected strongly. So 38.54 is the key level here. We came down 10 points from it, rallied to it again, got back up above it into this 38.60, pulled back again, broke below the 38.54. But it's to a higher high, 38.49, tried it again, 38.60, got back above it, pulled back again below it, but closed the week and the day above this 21 EMA, and we'll be looking at what happens with this 21 EMA. You can see that it was going down, flattened out late last week. When we broke back below it, it sloped back down. It's flat again. So price strength, if that continues, it'll slope back up. Any pullbacks into it should be support if the bulls are going to win the day. If they're not, we'll give way. We'll get out with a very small loss. But what we were looking for intraday, again, that 38.54-ish, 21-day moving average. Let me bring in a smaller time frame chart and some stochastics here. And here's what we're looking at. This is the first move back above it. Then I like to see a little bit of a pullback if we're not going to run away, just to get the best possible entry. So when we pulled back here, this is where we took our two entries. First, 7.5% SSO, and then another 7.5% SSO when we turned back up off of this low. That gave us our 15%, which is equivalent of 30% long, because SSO is at 2 times S&P 500. So that is how we entered SSO intraday, and then no real great gains. We're up a lot on it, but we break this 21, we can be quick to pull the plug and get out of it for a minimal loss. I've said several times, these little paper cuts, it's no big deal, because one big trend will pay for them all. This was a nice trend here. This was a nice trend here. Get a lot of false starts, but as long as you cut your losses and keep them minimal, and then you just wait for the market to take it higher and your equity curve along with it. So that's the S&P 500. Let's go to the NASDAQ 100 now. Above the 21, but right into this 50-day moving average. So last time this happened, which was late of the prior week, 7778, we failed at the 50-day moving average, then we failed at the 21. We took a stab here. When we broke below it, we got out of the way. But again, supported in this area, very similar to the way the S&P was supported. This just happens to be the 280 level on the NASDAQ 100. Repeatedly coming up as support twice this week. Market can't go down. It's got to go in a different direction. It's got to go up if this support is holding above the 21. We'll see what happens when we come into this 50-day moving average here. Back to the S&P 500, we got about 2% above us until we come into this 50-day moving average. But before that, we'll run into 3,900 and see what happens there, as that has been resistance from 7.7 and 7.8. Next up, next big cap index, Dow Jones Industrial Average. Very similar to what we saw in the S&P 500. A couple closes above it here. We failed. Now the big gap up, close at the high of the day above the 21. The 21 flattens out. Again, this looks very much like the S&P 500. You've got the declining 50-day overhead. Now we get to mid caps. This is the laggard of the indexes. This couldn't get back above it on the 7th and the 8th. Failed lower, now coming up to the underside of the 21. The 21 still sloping lower on this. But now let's get to IWM. I think we closed right on the 21. Yeah, basically we did. Actually 0.02% below. So we're right on the 21. But look at the difference here between IWN. This is the value portion. It's below the 21. IWO was above it earlier in the week. We took a long here, but when we broke back below it, we took it off. Back above the 21, sitting right on the 50-day moving. Okay, 0.2 below the 50-day moving average now, but showing relative strength relative to the the value portion of the small cap index. So the growth portion is outperforming the small cap. Now this is the one that we pay most attention to. That's part of our G6, and I'll go through them all very quickly right now. IWO is the first one. FFTY. This is the IBD Innovator 50 Fund. This is lagging. One of the reasons why this lags is because of the rotation that's been taking place. So the IBD 50 index loads up on stocks that are showing outstanding relative strength. But when those stocks showing relative strength fail, as was the case, we got a bunch of oil stocks in here. They came down very quickly along with the FFTY because oil stocks became a big portion of the FFTY. So this is a very fluid index, and it's not uncommon to see it lagging when you see big sector rotation take place. So first thing you want to do is see the relative strength line flatten out. We got that. Then we want to see it turn up, get back above the 21-day moving average. So that's the second component, FFTY. Third component is QQQJ. This is basically a mid-cap NASDAQ 100. Sitting right on the declining 21-day moving average. Didn't make lower lows since this level back down here, so at least showing, and the relative strength line a little bit choppy, but also going sideways means it's not underperforming the overall S&P 500 the way it was back here when growth stocks were really getting taken to the woodshed, and then here in February, March when we had another leg down in growth stocks, and then here's another area of underperformance in growth stocks. At least now we stopped going down. That's the first part to recovery, is stop going down. So the next component is PDP. This is a momentum ETF. A lot of rebalancing took place with this one right here on the 17th. So I think this is rebalanced and probably got some oil stocks that have been good the prior quarter, is perhaps why this is lagging. But again, it is momentum. Momentum eventually will catch up to the stocks that are showing momentum. And we want this to get back above the 21 just the same way we do the rest of them. ARKK, the famous Cathie Wood flagship fund, has been sitting right on the 50, the 21, and the 8 for 2.5 weeks. When things coil up tight like this, they've got to go one way or the other eventually, and usually those moves are very strong. So if this takes off to the upside, great, we'll participate in that with some growth stocks that we have on our 21 over 21 list. If it breaks down, we'll very quickly be out of the way in our SSO long position. So keeping a very close eye on how tight this is. And then the last, number 6, is MDYG. This is the growth component of the mid-cap 400. Not showing relative strength, but not showing relative weakness either. It's right there on the declining 21-day moving average. So that's the G6. As I said, glad to see IWO reclaim the 21E along with the big cap indexes. So let's see what other info we have in here. Okay, Joe Manchin came out. Solars were hit early in the day very hard because he said he's not going to vote for any budget that has money for climate change in it. So that hit solars, but they recovered very nicely by the end of the day. The poster child for this would be Enphase, which was down over 10% at once. Broke the 21, the 50, and the 200-day, but closed at the top of the range. Big volume here. So for now, this is just a shakeout. Anybody that wanted to sell it did, and we'll see if it can move higher. Solar sector overall, as shown by tan here, not really showing any relative strength. So Enphase did drop off of the 2121 list, which I'll go over momentarily here. So let's bottom line everything here. We went from basically flat to a 30 Revere volatility adjusted beta of 0.30 with our 15% SSO. So we're a third volatile as the S&P 500, half as volatile or half the exposure of a 60-40 index. And if it goes higher, we'll add to it and we'll start adding to leading growth stocks. If not, we've got a very clear exit point at today's lows and or the 21-day exponential moving average. So the bottom line, we had a gap up day today, closed at the high of the day. Big cap indexes and IWO reclaimed the 21. That's some good news after not a lot of recent good news with the CPI number coming off. But that CPI weakness looking kind of short-lived now. Doesn't mean we won't roll over next week, but as always, we'll see how the leading stocks and the indexes act and we'll react accordingly. So you notice my comment from yesterday, no surrender, another hammer off of 37.15 to 37.40 support. Then we got the gap up this morning and closed at the high of the day. And as I mentioned, so we've got little by little, we reclaim these resistance levels that are above. Next one here is this 3,900 area, and then we've got the declining 50-day moving average, as I mentioned. So we went through all the indexes, we went through the G6. Now let's get into the 21 over 21 leaders list. We had 6 stocks turn over off this list. Here's the entire list. Let me pull this up. This is in descending order by how recently they were added. In other words, the higher number is newer. Oldies but goodies like Lilly, T-Mobile, and Vertex have been on it for a number of weeks. We've got 10 sectors, 18 industry groups represented. Let's go through, first of all, the ones that got punted from last week. We're going to start off with Zoom. You know, I've been talking this stock up lately because of how well it was acting since its last earnings report, but it's just given up any relative strength as well as its moving averages and came off the list. AT&T, this is a stock that I really hated the fact that it was even on this. There's no growth. It's got a decent dividend. The fact that it was on here was just the fact that people were hiding money into it to keep from losing money, and broke below the 21. Glad to see it goodbye. That was never something I was going to buy anyway. PDD, China stocks were hot for a while, but then COVID kicked back up, and then we had the Chinese government. There's always something going on there that just can't be trusted. Anyway, gap down early this week, broke below the 21 over 21 and is removed from the list. Northrop Grumman was the strongest of the aerospace defense stocks, but broke below the 21. Dollar General was on here below the 21, got a better replacement for it, though this is still retail discount and variety, still a very strong area. You see it's A+ rated group here. We replaced this with Ollie. I'll get to that in a minute. And then finally, Enphase taken off. It's very possible this might get right at the top of the list and get put right back on next week, but this is an extremely volatile stock and definitely something to keep an eye on. So going through this in reverse order of number, we'll show the ones that were added now. Roblox showing relative strength. Look down here at the 3-month relative strength. This is what I really focus on, not the fact that this is a 20 for the year-long relative strength. We know that it had a massive decline from 141 all the way down to 21. But what we're focused on now is what's going on in the last 3 weeks. And again, growth stocks stopped going down, and Roblox is kind of a poster child for the way a lot of them have been acting lately. Bottomed at $23.88. It's now almost a $40 stock, going sideways over the last week and a half and showing some good relative strength over the past 3 months. Roblox added to the list. BMBL, kind of the same situation, but got back above its 200-day moving average. A lot of these stocks that were beaten down quite a bit still have the 200 overhead, but not this one. Got above the 21, pulled back to the 21, poked its head above the 50-day, the declining 200-day moving average, 96 3-month relative strength, and the 3-month, the 6-month and the full year relative strength aren't bad either. And they make money, which is good, or they're projected to make money in 2022 and 2023. Bumble added. Lantheus, welcome back. Got stopped out back here on this on a big sell-off. We rode some of this up, gave it all back in 2 days on this big move down. Now it's building this cup base again. I'd love to see a little bit of a handle here next week. Relative strength, supporting price at all-time highs, actually before price. That's what you want to see. So this made quite a comeback this week. Added back to the list. Bros, working its way higher. Another one that came way off, had a massive gap down at its last earnings report. This is a case where big gaps down can be bullish because immediately that put the low in, and there's been nothing but buyers ever since carrying this stock much higher. In fact, it doubled in 4 weeks off the low, now going sideways. The moving averages are all tightened up here. You've still got 21% up to the 200-day moving average. Looks to be accumulated to me. They're a great growth story. I like the action. Qualcomm. We all know semiconductors are the poster child for a thesis that sounds great, but has not had price action supporting it. Semiconductors have been garbage this year. Big relative strength coming into Qualcomm over the last 2 weeks. You can see it's still below the 200-day moving average, but has reclaimed its 8, 21, and 50-day moving average. Got a big upgrade this week. Earnings in 2 weeks, still fantastic numbers. They make a lot of money, and their PE is only 13. And Ollie, this is the one that took the place of Dollar General. Somehow, when I was rebuilding this a couple weeks back, I'm not sure how Dollar General got put on and Ollie didn't, but Ollie is the standout of the group. It's made its pivot plus 20%, as you can see by this green shaded area here. Still a leader, still a strong group. Nice numbers, clear accumulation, A distribution, A plus group rating. Let's see what happens going forward. Maybe a 3 weeks tight will give a good entry area on Ollie's. Autozone poked its head above this recent consolidation, just like you wanted to. Note the relative strength line. UTHR, and starting with Autozone, these are all stocks that have carried over from last week. You're going to see a few shakeouts below the 21. UTHR is one very clearly. Medical stocks were weak early in the day, along with the rest of the indexes on Thursday. But nice move off the lows over the last 2 days. You're going to see this in a lot of these charts, including Celsius, 40% above average volume as it broke out of this little flag pattern today, looking really good. Monster Beverage, I prefer Monster to Celsius, but hey, the market seems to be liking both of them, as you can see by the relative strength here and this big, long double bottom base on Monster. CNC, part of a very strong group. Humana, a sister stock to this. Humana was up 3% today. This was up 4.5%. They've got earnings. But good news by Humana is good news for the whole managed care group. And a nice move today by CNC. Merck, pharma stocks continue to hold up pretty well. This big move here, this big 4 or 5 day move off the bottom into the healthcare stocks 3 weeks ago, seeing a lot of charts like this, just really going sideways, consolidating that big move. Merck near the top of that list. BJ, retail discount variety, again, good group. Look at all the movement up on BJ's over the last 2 weeks to the top of this big double bottom base. Fantastic relative strength. GTLB, hold on here. GTLB. Nice tight action, pulling back on lower volume into its 21. This could serve as a nice launch pad for this next week. PWR, another one that's a huge shakeout. This is they're related to electric power, gas, and pipeline. They took a dive early today on that Mansion headline, but again, like the solar stocks, a great recovery back above the 21 here. Chewy, consolidating here, great move since its last earnings report. This is what the kind of action I was looking for in Zoom to continue, but it didn't do it. Chewy with the insider buying, it did continue, but it's coming into this declining 200-day moving average now, so we got to keep an eye on that. Shockwave, great day. Not the volume that we wanted to see, though. Good relative strength and a breakout above this recent consolidation. American Tower continues to stay tight in the handle of this cup and handle on cup and handle base. They print money. Vertex, tight action here off the 21, just what you want to see. Again, another medical stock that's just consolidated for 3 weeks after a 2-week move up when medical stocks reasserted themselves starting back in mid-June. T-Mobile, undercut reclaim of the 21, still forming a nice flat base here, tight over the last couple of weeks. And finally, Eli Lilly. You got your shakeout on Eli Lilly yesterday. Thought about entering it, but didn't, as we were still below the 21 on all of the major averages. But Lilly with a gap up and held it today. And that's your updated 21 over 21 list. And that's going to wrap up this week's really long big show. So as always, love your feedback. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. So wrapping up the week ending July 15th. Reminder, it's not how much you make in the market, it's how much you keep. That's why we have a strict loss cutting protection, downside protection policy for all of our holdings. We recognize market strength and weakness using technical indicators. Get out of the way when the market's not acting well. When it starts acting well, we'll be right back in. Took the first steps in today. For about the 6th or 7th time since we exited completely earlier this January. We'll put a couple toes in. If it works, we'll keep going. If it doesn't, we'll be right back out. One of these times we're going to have a really nice rally, and we'll be compounding from that higher base, as I mentioned. That's going to wrap it. Telling it like it is, here's Don Vandenbord closing the week ending July 15th. Thanks for listening and have a great weekend.